up here. Oh, got some feedback there. I see Blind is in here. I see Eric is in here. I'm shooting out invites. Hopefully these work. I see my man Paul in here. What's going on, Paul? How you feeling with the Celtics? Celtics in 6? All right. We'll see. We'll hear from Paul in a
Celtics
second.
in 6.
That's what I thought. There we go. Marcus Smart will come back. It'll all be good. All right, Eric, how's it going?
Glad to be here. Thanks so much for the opportunity.
My pleasure. Okay.
Eric, I need to know something first. Are you hosting us from a minivan? Are you coming from a minivan right now talking to us?
I am actually in a minivan in the Mission in San Francisco with air conditioning on. You got me. And I'm actually wearing a Juicero Patagonia vest. No joke.
Oh my God, you're a caricature, man. But I love it.
Wait, is that the one where if you squeeze the pocket, some carrot juice leaks out?
That's right, Paul. And the same thing happens to me when you squeeze me too. Carrot juice comes out.
Yikes.
Oh, hey, it's some of my favorite people. This is fun.
I know. I'm so excited to be here. So many friends.
So, Paul, do you want to kick things off with that roundup of what happened at the All In Summit? Because you had a great thread about something that happened between Cal and the founder of Oculus.
Sure. So, hey everyone, nice to be on. I ended up at the All In Summit mostly thanks to Paige, and it was an exciting experience because I think unbeknownst to everyone, the day 2 kind of keynote speaker, Palmer Luckey, gave his talk about the future of defense and then finished it by addressing some grievances that he had with Jason Calacarakis, who's one of the guys who was putting on the conference. So he kind of made it a point to address his grievances in a pretty public way. It started off maybe a little funny. He decided, he made a preamble of he was going to do something uncomfortable, and then he started talking, giving quotes of things that Jason had said about him, and it started off a little like celebrity mean tweets, right, where someone reads some things, and the joke of it is obviously they're a good sport. And so he started reading a bunch of things, and they got worse and worse and worse. And then after about the third minute, it took a pretty dark turn. So Palmer said, you tried to destroy me in my career. I think he said, I'm filled with rage and always will be. I thought I would be at Oculus for the rest of my life. It's all I ever wanted to do, and that got taken away from me because people like you and other people in the media really wanted to kind of keep me when I was down. His specific concerns were really attacks that felt personal. So I think he took issue with not his business performance, but where it felt like Jason and others crossed the line. And he basically went on. He went on for about 5 minutes, and this was at the end of his kind of keynote speech. And then as he came out and finished that, basically Jason and the other hosts of the All In podcast joined him on stage, and it continued. So he kind of sat down with Jason. Jason tried to, I think, dismiss the tension a little bit, and Palmer just kind of went right after him and said, the only reason I'm here is because I got kicked out and I clawed my way back, and I made myself, a billion, found another unicorn. And if I wasn't here, you would never speak to me again because you thought you were done with me. And they had this like super, super heated and intense back and forth. And then, over time, things kind of settled down and they hugged it out at the end. But it was definitely a very intense and distracting and deeply personal moment. I think at one point, Palmer said, if I sound like a thin-skinned billionaire, oh well, and kind of moved on. If I sound like a man-child in shorts, oh well, like he was kind of acknowledging the absurdity of what he was doing. But he was definitely there to deliver that message and kind of have this big confrontation. So yeah, it felt uh, complicated. I felt a little sad for Palmer. I mean, I think he was, clearly still chewed up about all of this. It felt a little performative and a little dramatic. And, people had lots of different reactions to it. I think on the positive side, there were people who felt like, man, this just shows you that you can have free speech. This just shows you that, people can have dialogues like that. They felt like he was brave for doing it and kind of confronting someone. I think there are people on the other side who would say, hey, this was, totally inappropriate. This was kind of blindsiding. This just was uncivil. And certainly this is something that could have gotten handled before he got out on stage. So I think it kind of created a little bit of a dynamic that hung over the rest of the day that was hard to get past, which was just, it was like personal, like it was personal on both sides. So I don't know that the conversation ever got into the ethics of what you should or shouldn't do or shouldn't say. I don't know they ever got to anywhere substantive, because I think because it was so personal and intense, that the other hosts on the stage kind of diverted Palmer away from going after Jason. And certainly there were some optics about resolution. But Jason's apology was, "I'm sorry if anything I said ever hurt you."
The non-apology apology. I love
Yeah,
it.
like one of those. So it didn't feel like they ended up with kind of a clear connection, but it was definitely a very odd experience in the middle of this conference. And
That's wild.
yeah, so that kind of set the tone for day two.
Well, at least they both have their bank accounts to fall back on, so that's always good. But yeah, thanks for giving us some of that juicy gossip, because that's the backbone of VC Brags, is just like the juicy gossip of the VC world. So that's really interesting. Just to switch gears for a second, like with all this market downturn and stuff, that's one of the themes of this room. Some of the panel speakers here, what are you guys seeing in like the VC spaces, like this quote unquote like downturn and things are happening? You want to share your thoughts on that?
I'll pop in for a second and just just for the sake of the space. I do want to make sure everybody gets time. So if you want to run it, I would say just call on specific ones, and we'll just kind of go person by person, because I want to make sure everybody gets a chance.
All right, sounds good. Eric, what are you seeing in the VC space right now?
Yeah, this is really hard for me to interpret, and what do I know, right? But I think that there's a lot of VCs who are talking their book. So some of the stuff around like we're in for a huge downturn, like yeah, there's evidence that maybe that is going to be happening, but it also is maybe a little bit of saber rattling for signaling that VCs are kind of tired of 2021 prices and want to go back to maybe the pre-pandemic levels when valuations were better, when there's more time for due diligence, when it didn't seem so FOMO'd in terms of the deal making itself. So some of that is like a little bit of an ulterior motive conspiracy that I've been sort of sensing from some of these louder voices out here. But what I suspect is happening, and this is just my strong opinion, loosely held, is that this feels a little bit like the flash crash in 2020. Pandemic happened back then. There's an overreaction in the market. We sat on our hands, and then for about 2 quarters. But then there's a lot of VC money that was sitting in the coffers that had to be put to work. And that's what started the bull run that we were enjoying until Q1 of this year. So my greater than 50% like odds on something like that could be happening is what my spidey sense is feeling. But there could be something more systemic here. And again, I'm not a macroeconomist, but those are my guesses, is that this is starting to feel a little bit like that 2020 moment. We are sitting on a lot of VC money. I think there's a record amount of VC capital that was raised in Q4 of 2021 and Q1 of this year. That money does eventually have to be put to work. And our LPs aren't going to be greatly happy if we just sit on our hands for a long time.
I agree with that sentiment.
Brandon,
Thanks,
or
Paul.
Paige or Brandon, if you guys want to speak, is there anything you'd like to add to that, just in terms of what you're seeing?
Yeah, Paige, why don't you go first? I'll take next.
Sure, sounds good. So like Eric, I'm definitely not a macro economist, just an early stage investor. So we focus mainly on the pre-seed and seed stages. And I think from the onset, we started investing in 2021. That's when we started writing our first check. So already prices were quite high relative to venture in the past. I think like I was at the All In Summit, and one of the things that Brad Gerstner said was that you should just forget the past 12 months ever happened, and we're going back to the old normal. And so I think this is one of the things that we're seeing is like we've been quite disciplined with our like entry valuations, and I think that that's prohibited us from a handful of deals that we were quite excited about. And so as the valuations are coming down at the pre-seed and seed, one of the things that we're really excited about as early stage investors is, as Eric mentioned, the opportunity to spend longer in diligence, getting to know the companies that we're investing in, and also at the valuations that were more prevalent prior to this big run up that Eric mentioned. I think one of the things that I'm looking at is while there is a lot of dry powder, it'll be interesting to see how much liquidity for these LPs was impacted, and how that corresponds to like different capital calls. So for example, like Brad Gerstner at Altimeter was talking about, and he was like, yeah, we're not calling any capital from our LPs for the next 6 months or so, which I thought was really interesting. So I think it is affecting early stage investors a bit less than growth investors, but I also do agree with Eric in terms of there is a slight suspicion in terms of folks that are talking up their book. I think Keith or Boy said that they hadn't made any net new investments, but I know there are some growth stage investors who have been very, very active within this past 2 months or so when things have really dropped to steep discounts at the growth stages. So that's kind of what I'm seeing. But I mean, I would say like companies are thinking more about, okay, when do we get to break even? How do we lower our CAC? How do we lower our burn? I think that folks that are founders are shifting more towards that perspective. Brandon, do you have anything to add to that?
Yeah, I mean, I think you all covered some great information, and maybe I think we're in, kind of similar positions that, so we're raising our fund currently under 506C, and we've been deploying as we raise. And so, we've been having these conversations with LPs and with founders daily, multiple times. And what I'm seeing, at least, is it sounds like LPs are kind of hesitating. Like Paige was just talking about. Brad said that they're not going to be doing capital calls for a little while. So I think that a lot of VCs are in that same position right now, where they're hesitating to do capital calls and hesitating to do growth stage deals, but maybe are looking at early stage where they maybe don't typically operate. So what I think is going to happen, at least, is that we're going to see a massive kind of pullback on growth stage for an extended period of time. And that's why everybody's saying, hey, have 24 to 36 months of runway. And if you don't have that, they're kind of saying good luck. When you hear that VCs are writing down their portfolios or marking down their portfolios 40%, 60%, etc., I hope that a lot of founders realize that's probably you if you're a growth stage founder. And that means your startup may not get supported at growth stage, and they're going to look and just try and get better valuations at early stage and completely reset. Now, if you make it through this and out of this period, they'll act like they had your back this whole time. But the truth is that we're in a period where they're probably going to write off the vast majority of growth stage, and I don't think that we've seen that fully impacted just yet. I just wrote a thread about all of this and on Twitter, and I'm sure I'll get a ton of pushback on it, from other VCs, but it's just the truth of what we're seeing in the market right now. And I mean, the best thing I can say if you're a founder is be cash flow, try to be cash flow positive, try to get there. Or if you're an early stage founder, make sure that you're working with somebody that's willing to be with you through the long term, not fund maybe your seed, but as soon as times get tough, you get to that A and it's rough. And we're in a tough period, but we'll get through it. I will say that we never had the high valuation problem, and it's just a function of where we operate. Every founder that we've invested in so far has been between a $2 million, $8 million valuation. So, those party rounds, those hype rounds, those FOMO rounds, it wasn't the overlooked founders getting those valuations. And so it hasn't been a problem for us. And I expect as the market continues to maybe go back down to those valuations, we'll actually see more seed stage deals done. So you're pre-seed seed. So I wouldn't worry that much if you're an early stage founder.
I'm actually curious to hear from the other early stage investors in the room if you all have preemptively marked down your portfolio, because I think that was like definitely a topic of debate at the All In Summit. We don't preemptively mark things up, and so we don't preemptively mark things down, but I'm curious to hear more from the other fund managers in the room about your thoughts on that.
We haven't at Hustle Fund. I think, when it comes to being pre-seed and seed stage, Paige, I think we're really consistent with how you're treating it. Is we don't preemptively mark anything up or down, but also like we're in a category where there's always going to be volatility of the state of the business, even during good times. Just one data point is just one company that I know of in our portfolio that was very, very close to death. This is during 2021, but the team just sort of put their heads down, pivoted their business model, and now they're performing as one of the best companies out of that portfolio. It was just really difficult for us to predict who's going to be breaking out or not, especially at the pre-seed stages. I think there's a little bit different kinds of sets of indicators that take place at the growth stages. Like if you're at Series C or D or whatever, and you have like 5-year trailing EBITDA LTV CAC ratio set up and like this, all these models and spreadsheets and historic data, maybe there is a bit more, evidence of data that you can use to do proper forecasting of as to whether the business is going to turn up or down. But at pre-seed, we kind of just expect and in some degree welcome the volatility of this ride. And our portfolio, our fund is 5 years old, so even our portfolio is still somewhat young. So we've communicated that our policy is just we'll mark up and down based on the data that founders provide us in terms of their latest raises.
Christina, do you have anything to add on that? Noticed you jumped in the room. Do you have anything you want to add?
Yeah, I think it's interesting. This is all happening in real time. And Eric, the one thing I do disagree with a little bit in terms of, you said there's a lot of dry powder. I think there was like $250 billion or $300 billion invested in VC last year, which was like a lot, has been increasing, but 70% of that or something was invested by non-VCs, and those people don't need to stick around. So if you think about all of the capital available, will it go down by 73%? Like maybe. Will it go down by less? Will it go down by more? I think the funds that we're investing on like an 18-month fund cycle are probably like on average 9 months away from being out of money. And so it used to be more like a 3-year cycle. So I think people are going to try to stretch that out longer. LPs are thinking about this asset class differently because interest rates have changed and we don't know how much they're going to change. The Fed has like not been consistent on that. So I think the big issue right now is there's this deep uncertainty about what things are worth at scale. And that makes it hard to value growth stage companies, and it's going to make it even harder. It's going to make it not even harder, but it will make it hard at some point to value early stage company. We'll see that trickle down effect. But I just from on the ground, I think things are still happening right now. So I agree. There's still a lot of exciting stuff happening at the early stages, and it's you want to make sure you're backing people that you want to go to war with and be in business with. And I am excited to spend more time with founders. It was kind of it's a tough situation when you meet someone that you love, but it's they have term sheets already, or you're just like, how do I get to know this person at a pre-seed or seed stage? So we'll see. I guess, I don't have the answer, but it's a unclear, deeply unclear situation at the moment.
Do you feel there's anything that, growth stage founders should be doing differently during these next 6 to 12 months? Because I saw that YC kind of memo that was put out that was kind of a bit alarming, but I don't want to be an alarmist or anything, but that sounded kind of weird from them. Tyler, do you want to jump in on this, and do you have anything to add?
Sure, yeah. I think the topic of markdowns is really interesting. We are a pretty unique fund. We are not really traditional VCs, although we invest early stage in technology companies, but we invest in what we call calm companies, basically like profitable or profit focused companies that are not necessarily going to raise follow-on rounds. And because of that, we had to design our own kind of valuation methodology to basically work backwards from the idea of why are we sharing things like TVPI? Well, I think it's to give LPs some guidance that, our sort of best guess towards, where we think the fund is going to end up. And so we've basically built our own methodology we made it public and all that, but it marks up and down based primarily on revenue milestones, right? And we do take markups when companies raise follow-on rounds, but that's not the majority of our portfolio. And that's also how like a lot of private equity works as well. So I would like to see, and I wouldn't be surprised if we start to see some changes here where, GPs are a little bit more on the hook to actually kind of give guidance on what's going on in their portfolio versus kind of following very, very strict kind of programmatic rules around this. I mean, I know it gets tricky, especially once you have lots of institutional investors and you have to audit and things like that. But still, it is strange to me, the kind of like almost like lack of autonomy among a lot of GPs who are just kind of like, well, what can we do? Like price goes up, price goes down. We just wait to see what the rounds happen. I mean, I don't know. If I was an LP in a lot of funds, which I'm not personally, I would want a little more convergence between what was being reported to what the GPs actually thought was going to happen. But maybe that's just me.
Michael, do you want to jump in on that? Do you have anything to add on that whole topic?
Yeah, sure. How's it going? Thanks for having me. Yeah, I think it's interesting to see on the, I've been at this for like 8 years now, and I feel like this is one of the first times that LPs care a lot less about markups, frankly, and like a lot less about MOIC, and IRR doesn't really matter 2 years into a fund, but like at least some of those metrics. And they're actually starting to ask questions around like the underlying companies and the growth of revenue and where you think they're going and how big the market opportunities are, which I think is great. I think some of them are also looking at like, they care a lot about the quote unquote quality of follow-on investors, and obviously brand name funds following on is helpful, but I think LPs are more skeptical than they've ever been on the markups because they know the last two years are haven't really been real, and I tend to think things will normalize back to kind of pre-COVID valuations, and I think it's going to happen pretty quickly in pre-seed and seed. It's already happening in A, and then the other thing that I'm seeing, which I'd be curious from like Christina and some of the other bigger brand name kind of multi-stage funds, is it feels like a lot of the big multi-stage funds that were starting to do seed because A's were getting it really expensive, are starting to back off from doing seeds now because A's are starting to normalize back to being in that like 10 to 15 range instead of 15 to 25 range as the normal. Which I think, when a lot of the big multi-stage funds were coming down and doing seed, they tended to be a lot less price sensitive because they just wanted to kind of, deploy more capital and get in to have an option to write a bigger check. And so they tended to drive seed prices up. And if a lot of them are starting to kind of back away from doing seed, I think that will just be another pressure down on seed valuations. But it'll be interesting to see. I think founders were so used to hearing their peers raise at kind of what I think are really high seed valuations. And so I think there's still a bit of a disconnect between what investors and founders are expecting at pre-seed and seed, but I think it's going to fairly quickly normalize back to pre-COVID levels, in my opinion.
Perfect. Appreciate the insight there. Okay, pulling back in here for just a second. To everyone that's joined into the room, I'm pretty sure it's obvious, what the main topic is based off up here, but this is the first one that we've done of these in a while. So big thank you to all the incredible people who are up here on the panel. I recommend if you're a founder in the audience or someone that's involved in this world, definitely clicking into the profiles of the people that are up here. I'm very familiar with Paul, Lisa, and a couple others. But I'm very excited to be able to learn from a lot more. And, if you're also somebody who might be able to contribute to this world, we do have a full panel right now, but if you have comments or anything, my DMs are open, VCs, I think are open as well. We would love to have just more participation in this conversation. So we're going to switch it up a little bit to focus more on the founder side of things, because although a good amount of my audience is in that bucket, was there not too long ago myself, and we'd love to get some advice from some people who see this on the inside day in, day out. As to what some founders should be doing. So Lisa, I want to throw you a question. Just basically right now, is there anything different that growth stage founders should be doing over the next 6 to 12 months from what they've done in the past, several years?
Yeah, so I think the current state of events is there's been a bunch of talk and articles stating that VC dollars are drying up. It's causing a lot of fear, uncertainty, and doubt. And, the advice is if you are fundraising, you might want to rethink your valuations and raise for a longer runway. So rather than raising for a 12-month runway, you might want to raise for an 18 or 24-month runway. That was kind of the same advice that was given during COVID times. And valuations are coming down significantly. And I think that's actually good for the industry long term because, unicorn companies are built during recession times. So, for example, the next Googles, Ubers, Facebooks will be built over the next decade. And, I think inflated deals aren't good for anyone, right? Investors don't get good deals. Founders become entitled. They don't watch their spend or practice operational efficiency. People are chasing paper money and markups rather than building actual value. So I'm going to speak on the crypto and Web3 space since I'm an early stage Web3 investor. And I think it's important to understand how the current global economic conditions are affecting venture capital. So take Terra, for example. What happened last week? That triggered a whole landslide in the crypto markets. And why is that? What happened? Traditional finance lost confidence in crypto when a supposed stable coin is no longer stable. And we all know they were not an actual stable coin, but the traditional industry doesn't understand the difference. And as soon as confidence is lost, there's a massive reaction and pullout. And VC is funded by traditional finance, right? On many occasions. And so it's like we had a digital bank run over the last week. So what happens when a country has an unstable currency? There's a bank run. People pull money out. That just happened with digital currency. We witnessed that happen with Luna. And just this week, investors pulled $7 billion out of Tether. Now, if Tether crumbles, it will cause a death spiral in crypto. I'm still long crypto, so it doesn't affect me. My hope is that the market bounces back. Investors don't let one bad apple deter them. And the right builders and founders continue to be heads down, building the unicorns of our next generation. So I think there's definitely a market correction, a reality check, right? We're not going to see these, pre-seed valuations of 40 million like that. And that's good for the industry because we do want founders to have a healthy path to fundraise. If you raise at too high of a valuation, you're actually shooting yourself in the foot. And I think that's a lesson that founders aren't really taught. They're just taught to fundraise at the highest valuation possible, but that's actually not the case. And I'm sure I want to definitely hear from other VCs in the room. But my encouragement is that if you are, building some of the best unicorn companies are built during the recession times, and those people who can withstand, right, the recession and still get funded are going to be kind of the creme de la creme.
That is a great point. And Christian, I see, we just left. Okay. Yeah. VC, we almost had him. Lisa, that's a really, really good point there, especially about the last thing you want to have is a down round. And it's so cautious right now, right, with this environment to factor in, right, we want to have that valuation, but we also want to have a next round. that is an up round from here, even with this changing environment. I would love to throw it to Rick right off of that. Rick, if you want to chime in on kind of the same concept as to what founders should be focusing on over these next 6 to 12 months.
Yeah, so to give everyone some context, I am a journalist, the head of PR at Blind Professional Social Network, and we have a really on-the-ground look at how tech employees, people that want to get into tech, are seeing the macro results. And there's a lot of comparisons to 2020 and the downturn with the start of the pandemic, and the discussions aren't quite there yet, which is a good sign. You're seeing folks at Google and Apple, they're still, a little bit entitled and saying, we actually don't want to go back to the office. I'm not so into the return to office. You saw Ian Goodfellow go from Apple to Google DeepMind. And so there is some concern about recession, but not so much in the terms of hiring freezes or layoffs, which is an interesting point. There's some talk about, hey, is this quote unquote great resignation ending? Certainly not in tech. There's still jobs out there. There's still companies that are opening up the talent pool. And so it's a really interesting kind of down to earth kind of sense that we see.
That's some great insights to be able to be on the floor for like that, just so ingrained within it. What's one of the things I would say about the changing areas that people are focusing on, specifically, I think it might be interesting to hear. Somebody in my DMs pointed out, they said, it feels like here, I'll just kind of pull it up so I don't mess up what they're asking. Okay, it feels like they've seen a lot of valuations dip, but that it seems like some Web3 firms have not had those valuations dip yet. Have you seen, maybe not just specific to Web3, but certain specific areas of the market or different areas of your sectors or industries that are not being affected the same way?
Yeah, so in terms of big tech, that is quite secure. Even though you're seeing some share prices get knocked down 10, 20, 30%, there are commitments to no hiring freezes. And so these are folks like Airbnb, which just recently announced work from anywhere policy, Microsoft, Amazon actually increasing stock-based compensation. We're also seeing some of this new cohort of just recently IPO'd companies actually going back to their new hires and giving out one-time adjustments to make people whole again. So there's this concern of, yeah, we know you're reading the news out there. You're going on Blind, you're talking about, hey, is there a recession coming? But we're actually going to do our best and retain you. And so it's a good time to be in tech right now. It's a good time to look at these more mature startups, even these recent IPOs that have been getting slaughtered, and obviously big tech.
Okay, interesting. So big tech definitely holding up well. Okay, we hit a couple VC. I'll pull you back into it if you want to throw that same question to anyone else, or if there's another topic you want to roll us into.
I want to ask Turner about what memes play into his whole thing, but you're just a listener, so yeah. Turner, come on up on the stage. Be a
Turner,
speaker.
come up.
Let's peer pressure him.
Turner, don't come up. Just kidding.
A little reverse psychology. All right. Well, I also saw we got Mariano came up as well. If you want to kind of push first. Hey, how's it going?
Hi everybody. Thank you for the invite. Great panel. I guess I wanted to talk just from a Latin America standpoint, right? And certainly there, the way I think about the region is obviously it is a hot spot right now. And one of the reasons is because it is a perfect storm in the sense that, at least in Mexico, the vast majority of the population is unbanked, do not necessarily have access to financial services. But on the flip side, more than 76% of the population has access to mobile devices. So that creates an enormous opportunity for certain industries like fintech, commerce, and certainly logistics and everything that supports all of that activity. So whereas in the case of crypto is something or Web3, I should say, is something that is still not as prevalent in the region, so not so much of an impact there. But also when it comes to fintech, I still see companies with similar valuations to what you would have seen last year, particularly fintech and logistics. Everything else seems to me that has gotten to the point where founders have begun to realize that they need to do something, right? Even founders who are coming out of YC are, quickly learning that I guess the party has ended to a certain extent, and I think the wiser founders are adjusting to the to the way the market is now, and making sure that they do not give themselves such a high valuation that prevents them from raising another round again. So that is in my opinion, what is happening right now in Latin America.
Well, I really appreciate that insight there. That's definitely something in a different area than honestly where my main focus had been. And it's good to hear that it's still thriving, that there's opportunities as well, but that changing like the rest of this. So I want to also just say now, so everybody's had a moment to speak. It's obviously difficult with large panels. So if at any point anyone's speaking, if you want to come in next, I'll just ask that speakers go ahead and just use that raise hand feature. It's when you hit that heart plus emoji. It's all the way on the right. You can just raise that hand, and I'll be happy to come to you right afterwards. But I want to bring it actually over to Paul, because Paul. Actually, VCs, did you have something there?
Yeah. So Brandon had an interesting thread on this. Like, at the end of the day, like VCs overfunded the market, but aren't actually taking accountability, in terms of what's going on. So Brandon, do you want to talk about that a bit, because you had some interesting takes?
Yeah, thanks. I appreciate it, and definitely looking for some hate mail from that thread, I'm sure. But I just think it's really strange, or I'd love to hear. I guess I would just love to hear some accountability, right? Every thread that I see, every thought piece that's put out there, every memo that's put out there is talking about founders raising at too high valuations. It's like placing blame on founders, and yet we're the ones that wrote the checks. You see what I'm saying? And so I just I guess I just wonder if we actually take a step back and look at it and say, you know what, the concentration of capital it's been too concentrated for too long, and we're not going outside of our network. So again, I'm not virtue signaling here, but one thing our fund does is we don't take any warm interest. We actively refuse them. We refuse them from our LPs. We refuse them from our advisors. We refuse them from our friends, network, whoever. You have to go through the same process to come, that everybody else does if you want to get funding from overlooked ventures. And that's something we've done from day one. And the reason being is we knew these hype rounds, these FOMO rounds caused inflated valuations. Those inflated valuations caused, at some point, the Pied Piper need paid. And I think Lisa hit on it great, where she talked about it's if you go to raise that next round, at some point the valuation is going to be untenable, right? And that's what we're seeing happen now on a mass scale. And the simplest, I mean, we do have a solution. It's such a simple solution. Expand the network, right? We get 100 to 150 applications a week for funding for our fund, and they all come through the website, and we review each one of them individually and respond to each one of them individually. Now, I understand we're not a $1 billion fund, right? Maybe we can't sustain that, but I think that we can at least help set a precedent for it, and that's what we're trying to do. And so I just look at it and I say, how can you fund 30 million, 40 million, pre-seed, pre-product, pre-revenue, maybe ideation phase, and then tell founders, hey, you know what, batten down the hatch, good luck to you, no accountability on our part, but if you get through this next round and if you stay tough and get through this stuff, then you'll be the next Google or Apple or whatever. And I just think we have, as an industry, we have to take a step back and say, you know what? We made mistakes. I'm taking accountability for those mistakes. And here's what we can do in the future going forward. We don't have to rely on only warm intros. We can keep an open process. We actually want to expand the network because there's numerous overlooked founders who never received a penny of funding. And then there's numerous, I mean, we funded many of them that their valuations were extremely reasonable because they weren't in that hype or in that network to where it was causing hype and FOMO rounds. And I'll just say, you know, we talked about markdowns and everything. We haven't had to do a single markdown, not because, you know, we have no idea what we're doing as, you know, new emerging fund managers, whatever you want to call us, but we haven't had to do one single markdown because our average valuation was between 2 million and 8 million. Right. So we did that on purpose. And then now our founders that are going out and raising their next rounds, they're not running into many of these same barriers. Even founders that are, you know, going into Series A and stuff, they're not running into those same barriers because it was priced correctly from the beginning, because the network was expanded beyond these hype and FOMO rounds. And so I just wonder if we're going to, as an industry, take accountability and responsibility for the mistakes that we made. And if we don't, and if we're not willing to have an open and honest conversation about it, I just think we're going to go through a short period of maybe a downturn and then run into the same problem and make the same mistakes again. And you know, my last point on this isn't just rich people's money. Like we look at this funding and we look at these millions and sometimes billions of dollars, and we see it as you know, it's just numbers to us. When I worked in a bank, like, you know, for a long time ago, I was a teller at a bank for a short period before going on and doing other things in the bank. And the money just became, you know, paper money. It wasn't even money to me. It was just, you know, paper, monopoly money. And we look at that, it's the same in venture capital. But what I want us all to think about is like, these are pension funds. These are endowments. This is public money. And I just, we have to take that responsibility very seriously, because somebody like, you know, my mom, she just retired 2 weeks ago, literally a little less than 2 weeks ago, and she's collecting a pension from a job she was at over 25 years. If the public markets and private markets and everything goes down, like there's the potential that somebody that's at her same job now may not be able to collect on their pension because it could not be sustained. And we have to take that responsibility seriously. So I just wonder, as an industry, if we're going to step back and look, or if we're just, you know, going to count it as part of the cycle.
Paul, you want to jump in on that?
Yeah, I think so. I'm primarily an LP, so I feel like we're talking esoterically about LPs. So I can give you my perspective. I'm an LP in a couple funds of people here. I mean, here's what I can tell you about the market. I have seen SPVs for, you know, I just saw an SPV that originally came out and was looking for a 500 million post-money valuation, cut to 200 million. I've seen 150 million get pulled. And these would be names that you would know. So, you know, there is an awful lot of churn happening at that like A-B stage. I haven't seen that looking at, you know, pre-seed and seed, which is primarily where I've spent my time. But I think, you know, the macroeconomic picture right now is really boils down to you know, inflation and the Fed and their inability to be consistent about it. Someone said earlier, I've unfortunately become convinced that the crypto boom probably was just a sponge for some of the excess capital, and that has trickled down to NFTs, which is something I study academically. So I've kind of come to that reluctantly. So I don't want that to be true. But I think the churn in the market that's going to be short term right now is going to be on these. I like a term that I heard at the All In Summit, which was customer surplus models. So if your business is predicated on cheap capital, meaning you're basically funding losses so that you can get a larger piece of the economic pie, so you can get a larger percent of the entire market, or it's a winner take all market, I think those are the businesses that are going to get clobbered, because as cash becomes more expensive, as financing becomes more expensive, it just breaks the business models. So I think that's where unit economics is going to be critical. So I would say anyone who's going to get good unit economics, anyone who's got a plan, those who are going to be successful. I read the YC memo, and it's written as like, if you haven't found product market fit after your seed stage, maybe you will have a problem. And I think a lot of that was just written for some really great technical people who maybe don't have business operational experience, and just trying to explain to them that we're in an economic position that the average 25-year-old hasn't seen. Me being almost twice that. I've seen some of these things before, so none of this is incredibly surprising. So I think there's a sector of the market that is overreacting, and there's a sector of the market that's probably reacting appropriately. So I think in the near term, if you get your unit economics right, if you can be cash flow positive, if you can, God forbid, figure out a way to make money, all those things are going to serve you. And so I think it's just going to wash out some of these other businesses that are really predicated on making money when you get to a certain percentage. And I was around doing this stuff in the 90s, and let me tell you, pets.com, their market plan was like, when we get to 700 million in revenue, we will be profitable. And that was the reason they didn't work. So I think anyone whose business model is predicated on market share being the driver and not good per unit economics is going to get pasted. And I think that's why Uber is kind of waking up to the unfortunate reality that that's a problem that even they have to fix. So I think that's just the moment that we're in now.
Hey, Eric, Paul, do you want to jump in on that? We have 4 minutes left before we jump into a rapid fire session with Blind, but if you want to just jump in, go ahead.
Real quick, Paul, can you
please.
accept the co-host I sent you? Done. There we go. Okay, all good. All you, Eric.
Yeah, no worries. So, I guess one of the things that's also a bit confounding, and Brendan, I'm really processing your thoughts, which I really appreciate the accountability, is also like an expectation within this industry. So when we launch a new fund in venture, at least at the early stages, but more commonly, I think across this asset class, it's a 10-year life of the fund. So the perspective I think I've always had about this was you're pricing in a recession to happen within this period of time. Now, we had the 12-year bull run, but that's a little bit unusual, right? I think like recessions, like in general, like every 5 to 7 or 8 years or something like that historically. I'm not sure if I'm driving to any real point here, but this is like part of like the overreaction I sometimes feel about this moment is just like, why are we so surprised that, these kinds of moments of stress would happen in this kind of a cycle? And why would you change your strategy fundamentally as a VC fund? Because, we were building for the long term ostensibly. Now, I think Christina actually made a really interesting point, which is, actually strategies did change. Now that we're doing these 1-year re-up cycles with funds, when the typical was like 3 years historically, maybe that did change kind of like timeline expectations. But I guess like seeing a lot of the FUD out there, it felt a bit like an overreaction. I'm not saying that there won't be periods of stress, maybe even 2 years of stress, who knows? But this is kind of the business, right?
Absolutely. Appreciate that, Eric. Okay. So I know we have about 2 minutes here, so I'll go to Tyler, and then we're going to do that 10-minute piece with Blind. During that process, in order to get Blind up here, we might have to rotate people. So just because I only get 10 speaker spots and 2 co-hosts, so we're at max right now. So that's why for anyone that's requesting, we'd love to bring you up, but we just don't have spots. But we will rotate people. So we'll hit Tyler, we'll do that 10 minutes, and then we'll have 15 minutes after that because we have until 9:15 p.m. EST sharp for this space. And so we'll hit Jonathan, who came up, and then maybe we'll rotate and bring up Henry as well. So Tyler?
Yeah, thank you. I just wanted to double down and expand on something that Paul said and just speak to founders for a second, which is that, in times of lots of uncertainty, the greatest source of optionality that you can get as an entrepreneur is to be cash flow positive, right? To not be dependent on raising another round. And I think it's important for founders to, not every founder in every situation, but many, many founders should be making sort of, serious decisions around pulling the few levers you can do to get to break even faster, which is, grow faster, cut your burn rate, and maybe, raise a sort of bridge round or even a down round if you have to make sure that you get there. And I think it's important for founders to really consider that because, you should acknowledge that if you are one of the founders who just raised some of these really sky high valuation seed rounds, Series A's, that sort of thing, your previous investors are really no longer aligned with your incentives because most founders want their company to succeed, right? They want to increase the chance that their company does well, that their employees do well, and that they get to a sort of to some level of success. And if you just raise a round at a really high valuation, the incentives of your investors are, for you not to do a down round because then they have to mark down their portfolio, and their incentives for you are to push as hard as possible to hit growth targets to do another up round. And that's not to say I'm not trying to disparage all VCs. There are lots of VCs who will fight their own incentives to do what's in the best interest of the founders. But that is the case, that your incentives are misaligned. And as a founder, you should, feel like even if that means pushing back on your investors and your board, you should be seriously considering how you can get your company to be break even right now. That's all I want to say.
Perfect. Okay, VC Brags, we are going to do rapid fire with Blind now, right?
Yep. Do you want to take the questions, or should I facilitate?
I'm happy to have you facilitate, or I can come in. I think you we talked about this a little bit earlier. So yeah. I mean, I'm happy to hit on that. That's no problem. But I just need the Blind app, if they're going to be answering, to go ahead and just hit the request button.
I think it's actually Rick who's going to be taking the questions.
Oh, perfect. Okay, Rick, you got it?
Yes, sir.
Awesome. All right, let's get right into it then. So I think we're going to start out with this. I would love to hear you kind of give us a tidbit before, but maybe you could elaborate on just a brief intro of yourself and the Blind app.
Sure, yeah. So the Blind is probably best known for being the top source of candid workplace insights. Think everything about company culture, career information like total compensation, which companies are hiring, interview prep. So it's basically an all-encompassing professional social network. My role at Blind is I'm basically the in-house journalist trying to surface these insights. We have a podcast that we share career advice with technologists. I work with media to kind of get the employee reactions to different business news out there, right? So when everyone was focusing about, hey, Elon's going to buy Twitter, everyone was focusing on like the 54-20, and we were out there saying, hey, this is actually how it's going to affect work-life balance for employees. Are there going to be hiring freezes or layoffs or sales and marketing travel spend cuts? That's kind of the role that we play.
Perfect. Okay, so let's talk a little bit about the insight side of this. So what really are the insights of tech hiring freeze, the recession fear, and specifically those coming from the Blind community?
Yeah, no, I think we haven't seen this level of activity since the start of the pandemic. Before the pandemic, in terms of the average usage, people were spending maybe half an hour a day on Blind. It's primarily focused on commute hours. So if you think about 7 to 10 a.m. and 7 p.m. to 11, 9, 10 p.m. Now it's all day, every day, with the peak at around 1 to 4 p.m. People are spending hours a day, and they're discussing things like recession. That is a 15x increase in the last year. Things like hiring freezes and layoffs, a 2x increase from the same time last year. And it's really about navigating, hey, I'm a technologist or I'm a finance person at the top of my game. I'm looking to get the most comp or get a better, bigger role. Which companies out there are still hiring? So less kind of fear, uncertainty, doubt, and more about that like raw, ambitious opportunism.
Perfect. Okay. So I know we also wanted to make sure that we talked about this podcast because there is a Blind Ambition podcast. I believe that was recently launched. Could you tell us a little bit about that?
Yeah. So it is kind of the atypical tech podcast, right? So if you think about the typical podcast that's out there, it's really like thought leadership, kind of PR driven BS. And we actually want to come in and say, hey, what are technologists thinking about? What do they want to do in terms of their career? So we're inviting VCs, heads of engineering, heads of people, and breaking down what is it like to get a job at Notion, right? Or at Gusto, we had the chief security officer come on and say, what is it like to actually be a chief security officer? And how did a black man from the South become a Silicon Valley executive, right? So really focused on that kind of perspective.
Perfect. Okay. I mean, those are a lot of the pieces that I want to hit on. We have about 5 minutes here for a little bit of Q&A. If anyone else wants to dig in or throw up, a hand, raise a question, I'm happy to have that. Would love to have I'm sure you all are experts at asking questions. I know. I mean, I've only had Paul question me a couple times, but I've been in the hot seat. But VC Braggs, I wanted to throw it to you for just a second, see if there's any other questions you wanted to throw in there.
Yeah, one for you, Rick, because I spent a lot of time on Blind. What's like the most absurd, hilarious question that you've seen asked on that platform?
So we get a lot of housing questions, right? And so these are folks that are making 400K, their household might be $800, $1 million, and they're asking, hey, can I afford a car? Or can I afford a house, right? And so you have this very raw kind of open questions where you realize, wow, sometimes like the smartest people sometimes are like a little dumb, right? So it's this really interesting kind of dynamic where because it's anonymous, you can talk about anything and everything. The outcomes are hilarious sometimes.
Yeah, it's nonstop entertainment for sure. Yeah, I guess we're coming to the end now. Does anyone else have any like questions or just anything on your mind?
Well, but if there's anybody else that wants to ask anything on Blind, that's cool. We still do have 20 minutes though of space here time before this 9:15, and I definitely have questions with really an elite panel up here that has I would love to throw around there. So VCs, anything else you want to say on the Blind app there, or do you want to kind of bring the conversation back to some others? And also we have Henry and Jonathan who haven't spoken yet.
Yeah, anyone who hasn't spoken, just go for it.
Perfect. Okay, Henry, I know that you had been chatting with VCs. I know that you're over there at Great Oaks VC, and also I appreciate the Tom Brady up there in the profile picture.
Appreciate that.
Perfect. So we'd love to hear your thoughts if you want to share. I mean, a couple topics we've hit on tonight. We've had some great insight from Brandon on the VC side of things, on accountability. We've also talked about what do growth tech founders need to be focused on in these next 6 to 12 months as they grind their way through a harder environment. But anything you want to weigh in on, or if you kind of want to talk a little bit about also what you do, feel free to weigh in.
Yeah. Sorry, I'm a little tardy, but appreciate you having me here. And yeah, I mean, I think everyone on here who is chatting has probably had a lot of conversations either with LPs, fellow investors, portfolio founders the last couple of weeks, because whether or not you want to focus on things other than purely what you're building and doing with your team, it's really difficult to ignore the noise that you're hearing from everywhere. So I'm purely a seed investor. I invest pre-seed, seed, sometimes Series A as a first investment, but really not past then. And what I've tried to do largely, now this is with companies that we are currently investing in or have invested in sort of the last 9 months, which is where we typically are most connected and involved with our companies, is not overreact, not freak out, as I've heard a few times already in this chat. If you're a fund with a 10-year time horizon, you're basically signing up to have some type of a recession or downturn, meaningful downturn within that journey. And the reality is this is expected. I think everyone who's an investor or an operator expected that at some point things were not going to be maybe as frothy as they had been. Now it's easy to know that it will one day happen versus when it happens. And I think you're seeing this sort of overreaction to the market today. And some of that is certainly the fault of LPs and venture capitalists who have, maybe marginally pushed founders to focus on the wrong types of areas. But at the end of the day, nothing really has changed. Markets go up and down. At the end of the day, building for consumers or businesses, whoever your client is what any of these companies are doing. Now, it's up to you ultimately as a founder and an operator of a business to figure out what the real performance indicators are. I agreed with some of the comments. If your company is predicated on cheap debt capital, that you're playing with fire, and it's going to potentially be a fantastic business for a portion of decades, and it's going to be a shitty business for a lot of parts of the decade, and it's only possible to exist in certain environments. So in a lot of ways, nothing has changed. I think everyone can concede that to an extent, but we've just been trying to be a voice for our founders to really focus on the task at hand. Things might be a little bumpier in the short term if money's flowing less freely, but at the end of the day, the missions really haven't changed. And I think it's painful in some ways, but it's probably healthy to just really make sure that you're not sort of tagging along to the expectations of other people, or you're investing in a company purely because you think they're going to be able to raise financing at a higher valuation in 12 months. But, really thinking like, why am I starting this company? Why am I joining this company as an employee, or why am I investing capital in this company? And if you really simplify and bring back to the core of what anyone does, whether it's an investor or an employee or a founder, I really don't think too much has changed. And, we try to just sort of be a sounding board for that perspective. And I think that's at a certain point, all you can really do right now.
Perfect. Yeah, I mean, it's a great point there, right? When you have that type of time horizon, you accept certain environments with it. And then exactly like you said, right? It's like adapt or die, right? At the moment, it's the time to push through and just continue to focus on. And perhaps there's certain areas within the company that people put more focus on than others based on the changing environment.
Now, totally. And I would also just caveat that, I'm talking about the companies at seed and pre-seed that I'm typically working with. We have a pretty meaningful portfolio who have, graduated over the last 5 to 7 years to growth and have raised tens or hundreds of millions of dollars. I think those are very different conversations to have with companies who are, maybe planning on an exit this year and are unsure of where they've raised capital and if they're sort of below water. So I understand that as a seed investor, maybe it's a privilege to be able to talk that way and be so pie in the sky, because for a lot of people, it's a very different calculus and situation. But I can really only speak to my experience as a seed investor, and that's sort of how we think about the market today.
Awesome. Yeah, I appreciate the caveat there. Okay, perfect. Jonathan, you were requesting to come up. Would love to throw the mic to you to hear from you.
Yeah, thanks for having me on, and great conversation, everyone. I agree with a lot of the commentary. I think from the VC side, I'll comment really quickly that similar to a lot of what Henry said, it is a really exciting time for new funds that are deploying capital into early stage pre-seed, seed. I do agree with some of Brandon's commentary around, VCs, we kind of created the problem. And so we certainly need to be there to continue to assist founders, whether those are existing portfolio companies or new founders we're working with, set the right expectations about how much to raise and what's appropriate. But we certainly can't fault founders for raising a ton of capital and trying to minimize dilution and optimize for finding the best strategic partners on the other side of the table. It's really hard in that situation to fault a founder for that. But I want to play the flip side. So I'm new to the VC world. I launched this fund last year, but for the previous 10 years, I was the founder of an enterprise software company. And we raised, almost $100 million across that 10 years. And so what I thought might be helpful is for the founders that are in the room, what do you do at a moment like this when, it's all doom and gloom? The YC, blog post today is talking about all the things that could or should go wrong. Certainly the headlines are talking about valuation compression. And at least for me and a lot of the founders that I know got into this for, wanting to help customers and solving a problem, this is actually a really exciting time. And I would take the optimistic viewpoint because it kind of is what I would call the great reset. And it takes away all of the distractions. It takes away all of the, frivolous spending and the headlines and a little bit of the panache. And it goes back to the basics of just building great product, servicing your customers, and kind of the fundamentals of building. And for a lot of founders, that's just really exciting, and that's what they enjoy doing. And so I was in a board meeting the other week, and this was a software company. And these are some tactical things that they are doing that I think all software companies, whether you're early stage or late stage, should be thinking about. The first thing is obviously they're trying to think about their runway. And as a part of that, they really want to get ahead of renewals. And so most software companies are on annual renewals or month to month. And so there's a heavy outbound focus right now about shoring up your customers long term. So if you're on a SaaS, type of company, really think about your most at-risk customers. And in a moment like this is an opportunity to focus more on market share and logos than it is price optimization. So do anything you can to retain those customers, get ahead of those renewal conversations. If you're in a very crowded market with competition, it's a great time to do price matching and tactics like that where you can keep logos around. And then on the talent side, I would say there's a lot of people that are kind of going through the great reshuffle and thinking about where they want to spend the next 5, 10, 15 years. And so if you're a founder that has the opportunity to, you've recently raised or you have a decent amount of runway, it's a really good time to continue hiring. I remember quite famously Mark Benioff in Salesforce during the 07, 08, 09 great financial crash. They hired more sales reps at Salesforce during those years than ever before. And they were able to, accelerate their sales growth. So I recognize that not all founders are in that situation. But for those that have responsibly managed their business and, have a good runway and aren't burning a ton of capital, it's actually a really exciting time to be building the business, I think. So the last thing I'll say is, the founders that are going to be successful were never focused on the short-term gains or the monetary outcome short-term anyways. They're focused on building companies of impact over a decade. And so I think as someone already mentioned earlier, statistically, you're likely, whether it's at the beginning, the middle, or the end of your journey, to hit one of these road bumps. And likely you're going to hit a few as a founder. So I just take the long-term optimistic view. I know it doesn't solve always some of the really pressing challenges that founders face. But I feel like we're starting to have the pendulum swing too far on the fear index, and just want to bring a little bit of that optimism and excitement back to the table long term.
Perfect. Yeah, Jonathan, I think, a little bit of hope is good for sure. And I like that you point out, especially on hiring and other things, which I think people think that perhaps they just have to have this total freeze at the moment. That it's not true, right? And that there is still a lot of opportunity to look for. So great points. I appreciate that. All right, we have one more person who came up who has not spoken just yet, and that is Frederick. Frederick, would you like to weigh in?
Hey guys, yeah, just really quickly, I'm not gonna say much, but I will say that I do echo a lot of Brandon's sentiments. I love the way he laid that out as far as accountability goes. So I think that's very, very important for LPs and GPs overall, angel investors, everyone. We did kind of create this problem. So I have a family office. One of the things I want to say to first founders is this is a time to really be strategic. Managing your burn rate is going to be very, very important. Doing everything you can to lower expenses. And, when you're developing your product at this point, focusing on developing to customer consensus to ensure that you're only developing what you have to based on your overall customer consensus. So talking to your customers is going to be very key at this point. Surveys, polls, getting that key feedback. If you're not if you're tech based and you haven't started implementing things like Full Story and Hotjar, this is a great time to be doing that, to really be able to get deep data from your customers to be able to only develop what you have to continue to grow and scale and demonstrate traction. As far as, your runway, if you're running out of runway, a lot of people are talking about down rounds, but if you've got revenue and you're scaling and you've got customers, this is a great time to start looking at structured financing options. And learning how to manage your cap stack in a way that allows you to recapitalize your balance sheet without having to lower valuation. This is a great time to start understanding, learning that, and looking into that. For the VC side of it, what I would say is this is a great time to start considering accretive value proposition. If you're going to be pulling back on funding anyway, this is a great time to start digging into your companies, getting really active with them, and helping them grow themselves to a position to where they're in a better place to be able to exit. Because at the end of the day, exits is what generates the cash in the bank account. So I just wanted to say those things, share those things, and I'll leave it there. Thank you guys so much.
Perfect. Appreciate that, Frederick. Yeah, I mean, definitely there's options on the table. And that's exactly why it's important to have spaces like this and conversations like this so people know about those options. It's really difficult, coming into this world and knowing nothing. I see Michael's in the crowd. A couple years ago, we were kind of pretty new to this whole startup thing. And I venture to say we knew very, very, very little. And it's trial by fire. And, we're only been around for a couple of years and kind of looked at it. But during those years, I've learned so much, everything from, the legal side, the, customer acquisition, hiring, and all these different areas that are really, really tough and treacherous. So just to know different options in different areas is super, super helpful. All right, about 5 minutes here. Paul, I want to throw it to you if there's any other pieces, kind of clean up anything else that you wanted to hit on, any other notes, and then also VCs we can hit you. And then we'll be around 9:15 p.m. EST, and we have actually some more speakers that will be coming in another space. I love doing several hours of spaces a week. Real quick, just shout out to all the speakers as well. If you haven't already gone ahead and followed them, these are some great people to be connecting with. I pinned up top the thread from Brandon. You can check that out. All the others, you can go ahead and just click in right through their bios. Listen, this is an elite panel. I will say it one more time, and I definitely recommend throwing them the follow. I'm glad to be able to have them in my space. And if you like Twitter Spaces, I host about 40 hours a week. This week I'm traveling, so it's more like 20, 25 hours. But next week, I'll do my best to bring 40 hours a week of everything investment content. So stocks, crypto, options, NFTs, real estate, venture capital, whatever it is, we're here for it. All right, Paul, anything else from yourself?
I think it's just I'm gonna beat the dead horse. Get unit economics correct. Figure out how to get businesses cash flowing. And if you're a GP, really working with your founders to hold them accountable to hitting those milestones so that you don't end up out of runway. Again, I don't think we should overreact to things like the YC memo. It's largely just a matter of any businesses that are predicated on raising another round in the next 12 months. That's probably going to be 24 months. So just double how long you think you're going to need the capital for, and your best funding source is always your customers.
Perfect. Well, that's some great advice right there. All right, VCs, anything else you want to say on here as we have about 3 minutes left?
No, nothing on my end. Just want to give everybody a shout out and say thank you, but I'll still make fun of you if you're a VC, so don't brag on Twitter because I'll roast you still. Don't think I've gotten soft, even though, things have happened, but yeah, I'll still roast you all. But thanks for being on the panel.
Awesome, I love it. We can go around while I'm waiting for the next speakers to come in and just give some closing comments to each person up here. Once the next speakers come in, I'll bring them up on the panel. But Lisa, anything else you want to say on this one?
Yeah, just don't lose heart. Keep building, and stay focused.
Appreciate that, and glad we got to meet up at the event in LA last night, crypto event.
Yeah, definitely.
There we go. It's not just Twitter Spaces. I'm real in real life too. All right, let's go to Eric. Anything else you'd like to say?
Thanks so much for the opportunity to be here. It was a great panel and really honored to be here. And to the founders, this too shall pass.
There we go. Henry?
I would say just the only thing that I don't 100% agree with that was said tonight was, and again, this is from my vantage point as a pre-seed, seed sort of investor, but I don't necessarily think optimizing for cash flow at the earliest point of a startup's journey is necessarily the right solution. But I think, what is important is showing that, venture capital basically exists to fund losses for companies that, need that injection of capital up front in order to, one day become free cash flow positive and producing a lot of cash. So I think drawing a straight line or drawing really some type of model that has legs versus just a pie in the sky chart that shows that at this level of revenue we're magically insanely profitable but maybe it's being harder pressed on the model of making sure that there is that sort of pot of gold at the end of the rainbow, and pointing to reasons and really making a case for why you're worthy of venture capital versus just buying revenue, which I think is sort of the lesson of this bubble that we've seen. If the .com era was eyeballs and overvalued because there was not revenue, I think the lesson from this era was buying bad revenue, and slapping revenue multiples on things and acting like all dollars of revenue are the same. So I don't necessarily agree that everyone should be optimizing for profitability at the start, but showing that your dollars and your revenues are real revenues, and that there is a reason why you need venture capital investment versus bootstrapping.
Perfect. Okay, so just to note, we are at 9:15 p.m. EST here. I'm inviting up our other speakers for this next space. So IX, if you're down there, and also a couple of others. Julian, if you want to go ahead and accept those invites or request to come up, we'll get you up here. But we'll just go around and see if there's anything else. So I'll ask just speakers to make closing comments decently quick, but I still want to hit everybody. Brandon, anything else you'd like to say?
Yeah, I'll just say real quick, rethink it all. Rethink venture capital, rethink startups, rethink how we're funding businesses and who we're funding. And any future VCs down in the audience, don't be afraid to go for it. I have no college experience, no college degree, never set foot on a campus a day in my life. And I've washed buses, and I lived out of my car prior to this. And then I started a startup, learned along the way, and found my way. And now I'm a VC, running a fund and hopefully inspiring others to do so. Founders, you can make it happen. Get through this time. Follow your intuition. Your business is better than we do. And so, all this advice sounds great. Every thought piece, every memo, everything that's out there sounds fantastic, but better than anyone in the world. And that's why you're building your startup. Believe in yourself, keep going. And we're here for you at Overlook Ventures.
Love the passion. Yeah, very true. And I think a lot of people need that right now. Jonathan?
Yeah, I'm big on action items. So 2 thoughts for all founders in the audience. 1, increase communication with other founders. You're not alone. Some of the best things you can do at a moment like this is just to talk to other founders in different industries and share ideas. It's a time of experimentation, and everyone's going through it at the same time. So the more transparent and sharing you are, the more value you're going to get from others. And secondly, you're not on this journey alone. Hold your VC partners feet to the fire. Make sure they're adding value, and maybe update your frequency of updates to monthly, and start asking for 1 or 2 action items after every monthly update, and really make sure your VCs are on this journey with you.
Perfect. Okay, and VC Brags, I'll bring it to you for last remarks here, and then we have our next speakers. Oh, I saw IX was up here, but I'm going to get him back up, and we'll go to them.
No, nothing for me. Just if anyone keeps bragging, I'm going to roast you if you're in VC. That's it. Thanks.
Perfect. Okay, and while I'm just waiting for IX Swap to come back up, Frederick, do you want to say anything else?
Sure. What I'll say is, and this is particularly for founders, before I get into that, Brandon, I echo your sentiments so much. Like, I like you more and more every time, like, I speak and I read your Twitter thread. I like you more and more every day. So that's first. But to you founders, understand that if you think you're going to exit, if you think you're going to grow, if you think you're going to scale a company, you're going to see a number of different storms, small ones and large ones. Life's ebbs and flows of life. That's just how it is. And it's the same way in business. You can get through it, and you're going to have to get through it if you think you're going to exit, right? You can do it. Like, keep putting one foot in front of the other. Yes, it sucks. Yes, you're going to fall. Yes, it's going to hurt. Get up, dust yourself off, and keep moving forward, because at the end of the day, it's the lessons you learn and apply from your failures that are going to allow you to succeed. And even if it's not your current venture, the lessons you learn from this venture will help you succeed in your next venture. The key is not to give up. So if I could give went to Harvard, went to Oxford, if you have a college degree, come off the street, we don't serve on equal footing. This is a trial by fire.
Is it breaking up for anyone else?
So that's about it. Thank you so much, guys.
Okay, Frederick, that was awesome. I missed a little bit towards the end, but I might not glitch out for other people, but I really appreciate you coming up and sharing. We do have IX swap up here. So let me go ahead and real quick just change this topic and title. So to everybody that just, so nobody's confused, we just had a couple of spaces. So you may have come in here for our first space. We did a space covering tools for building in Web3. We then just did a space right now. This was a venture capital deep dive space. We had on, VC Brags and a number of other people. Lisa is up here, and you're welcome to tell me. So this might be right up your alley right now. And others. So Abbas was, coming on. And so this panel with the VCs, hopefully you really enjoyed it. You were able to connect with some of them, Paul, Eric, and a bunch of others that came up. We had people that weren't even planned that came up, and we obviously had a massive audience, and that was awesome. We are going to keep this space open. The topic is going to be changing.